And the ripple effect of that means that there can be, more cash going to the donor because there's less taxes paid because of that capital gains tax avoidance.
Hi, I'm Andrew Williams, founder of SecondWave Advisors and author of the book, SecondWave Life. I think you'll enjoy today's guest, and thank you for checking out the podcast. If you like what you hear, please use the link in the description to learn more. Pleased to be joined today by Laura Malone, Donor Relations Manager for Charitable Solutions. And Laura and I met recently at the EPI Vision Alignment event down in Cleveland, and I'm fascinated by what you're doing, what your group is doing. The volume of things that you've explained to me that is happening is really, really cool. So thanks for jumping on, and thanks for joining the video podcast today.
Yeah, thank you so much for having me. I'm thrilled to be here and talking about charitable strategies.
Yes, and so when you taught me about your organization and what it is that you do, it took me a minute to get my head around it. So as we get into these questions, forgive me if I start asking you fifth grade like questions, but maybe let's start with, what's your entrepreneurial story? This is a fascinating role that you have, a fascinating thing that you do, and you get paid to do it. What's your entrepreneurial story, and how'd you get here?
Yeah, so my story has been a winding road, I guess you could say, in the sense that I transitioned into philanthropy in 2009. I was making a transition. I started in the early 2000s working in commercial real estate, relocated back home to the Northeast Ohio area in 2008, and we all remember what 2008 was like, especially if you were in commercial real estate.
Yes.
And decided, I'd always thought about a career in philanthropy and thought of that as a retirement career, and then thought, well, why don't I try and put that, on the front end of my career rather than the back end of my career.
Awesome. Yeah.
And was fortunate enough to be introduced to the world of donor advised funds by a mentor of mine, and fell immediately in love with the idea of donor advised funds and what they could do for philanthropy. And for those unfamiliar, donor advised funds are, I would say, kind of a cousin of sorts to private foundations, but they allow donors to bring philanthropy into their lives, into a strategy, without having to have millions upon millions of dollars. We see a lot of donor advised funds being created by moderate wealth, can be done for, $10,000, $20,000, $50,000, in the general scope of donor advised funds, but allow donors to be more strategically minded when it comes to leveraging how they're doing their charitable gifting with their appreciated stocks and, with their cash, and really being able to create a little bit of a pause button between that taxable benefit of charitable giving and the act of actually contributing those dollars to their favorite charities of choice. So we're seeing a lot of things come into play that create leverage with that. And I just immediately loved the concept in general of donor advised funds. But through my time with the National Donor Advised Fund program, I was fortunate enough to meet a gentleman by the name of Brian Klontz, who is the founder of Charitable Solutions and also the founder of Decamai Foundation. And, for those of you in philanthropy, you'll know Brian because for 20 plus years, Charitable Solutions has been working primarily in the scope of non-cash assets and being able to work with donors and their favorite charities to take these assets that are normally not liquid, that are normally not easy to contribute, that are normally assets that charities run away from screaming because they don't know how to handle taking on a gift of that nature, and really being that charitable middleman of sorts to help create that non-cash asset into something that can be liquid, that can benefit the donor's charity of choice. So more often than not, in our day-to-day, that tends to be business interest gifts, closely held business ownership as owners are making transitions. We also see a lot of that within the scope of higher value real estate. We've seen a run right now, as I'm sure you can imagine, in the precious metals space.
Sure.
So getting a lot of a lot
How
of
about what if I had some
folklore.
what if I had some jewelry that had most recently been in Paris and I needed to move that? Can you help me with that kind of Can you help me with that kind of thing?
Yeah, maybe some jewelry or some fine art. We
Sure.
have
You
been
deal in
known
that? Okay. It's
to
good to know.
dabble in some of those things, provided that you have clean title to those assets.
Ah, okay. Let me
So
talk
we
to my
do want to
brother.
make sure
Yeah.
that you actually do own those and didn't just stumble upon them while you were wandering the streets of Paris, so to
Yeah.
speak.
Okay.
So,
Fair enough. Fair enough.
but
Awesome. So,
But Brian's
you,
been a leader in the complex asset giving space, and I was fortunate enough to become aligned with him just within the last year. But prior to that, I'd been doing a lot. I got my SEPA designation in 2014. Within my national donor advisement program that I was with previously, had done a lot within the complex asset giving space, and just really loved the ability to be able to align the idea of what can happen with philanthropy when business owners can be better engaged and better strategically in thinking
yeah,
through how to
excellent.
leverage their most valuable asset in these instances.
Excellent. And you tell me again, you got the SEPA designation how
2014,
2014. So more than a decade you've
more
been
than a decade ago.
part of the community and watching things grow at EPI. And I remember in 2014, like post Great Recession, right? The
Hmm.
expectation was, okay, well, since nobody sold during the recession, it's going to about to get really busy.
Yeah.
There's going to be all this tidal wave of transactions that never seemed to never materialized. Not in the turf I cover anyway, and I blame that on a variety of things. One of which, though, was that's about the time everybody got a laptop, and so if you're a business owner in northern Indiana, when it's time for the snow to fly, that's when you go south now, and you take
Exactly.
your laptop, and so there's no need to sell. But certainly, Father Time and Gravity are still undefeated, and things are seem to be starting to move right now. And we'll talk in a moment about how much work you all are doing. But so when you and I met, and you tried to explain to me, what it is that Charitable Solutions does, and I'm kind of scratching my head, then like I should understand it. So my question to you is, when you meet new people, or when you have friends and family that ask you, so what is it you do for a living? How do you begin to explain this to somebody that probably has no context at all for it?
Yeah, and it's a great question because I think sometimes I even question whether my friends and family understand it, no matter how many times I explain it. So, no, I like to refer to myself as a charitable strategist because I think there's a lot of
Okay.
ways that donors are under leveraging how they're doing their giving, and their business
Yes.
asset is just one avenue of that. And it's the biggest avenue that I deal with primarily these days. But, fundamentally, when you think about a business owner getting ready to leave a business, they are looking for strategies. They are looking, in a lot of cases, to be philanthropic when they leave their business and in that next phase of what their life is going to look like after the business. But oftentimes, they don't have advisors that are introducing that idea to them early enough in the process. So part of what I try to do is try to provoke those conversations to be a little bit earlier so that that can be a front of mind conversation and not something
Yes.
that's trying to be executed on at the 11th hour of the sale transaction, because odds are when you're
True.
getting to that strategy that late in the game, nobody's going to walk away happy. The donor's not going to be able to fulfill what they want to do with their charitable gift. They've already got so many plates spinning in the air. It's just impossible to try to integrate that. While the buyer might have been receptive to it, a month or two ago when they were first building the strategy of buying out the company, having that come on their table at the 11th hour is less likely to be favorable when they've
Yes.
already got 90% of the deal crafted. Really being able to think through how to best tax play that strategy in the long range is really where it begins to make more sense. So how do we look
Great.
at, bringing this front of mind with the business owners so that they can think through that life after plan, but also to really being able to get the best leverage in having that successful exit that gives them meaning, through what they want to do with their
Yeah.
philanthropic endeavors after the fact.
Yeah, I'm making notes here about people in my network in Northern Indiana and Southwest Michigan I need to introduce you to. Okay, so you alluded earlier that one of the things that you all are great at that maybe filled a missing void was this idea of non-cash assets, right? So why does that make it more complicated? How do you handle those things, and why is that such a big differentiator for you?
Yeah, it is a big differentiator because they are, the other phrase that's used a lot aside from non-cash assets is complex assets because that is what they are. When you're looking at the idea of, 80% of the wealth, is usually in these types of assets, business ownership interests, real estate interests, harder to value assets. It's not like cash or Apple stock where the donor can just write a check or just
Sure.
journal over their stuff from their investment account to a nonprofit's E-Trade account. Oftentimes to be able to facilitate these gifts, not only do you need to have, tax and legal professionals to be able to evaluate how the benefit's going to play out for the donor, but you often need, legal documents to transfer that ownership. You have to work through, if you're looking at a business owner, you're looking at the shareholder agreements, you're looking at the nonprofit going on the cap tables, you're looking at the nonprofit, if you're talking about your local nonprofit, taking on a lot of risk and liability because they're now a shareholder in XYZ widget company or whatever. And
Yeah.
most nonprofits don't know how to do that. A lot of them don't even have investment accounts to take marketable securities. So it's important to be able to have folks that know what they're doing in that space, that do this literally on a daily basis in our
Sure.
world, and to be able to take on that risk because a lot of organizations, if something goes wrong, and I shouldn't say if something goes wrong, but if the asset doesn't liquidate fast enough, then that's an asset that they're holding on to that they can't do anything with to further their philanthropy, to further their mission.
Sure.
And a lot of nonprofits don't have the capacity to take on that risk. They need liquidity as fast as they can to be able to do the work that they're doing, especially in today's environment. So it's really important that they are able to focus on what to do with cash and not really focus on the assets that may come across their table that are more particular to IRS scrutiny, that are more particular to the idea of IRS complexity, because there's different forms that need to be done, appraisals that need to be done as part of this gift process. It's not just a matter of, hey, I'm going to sell my company for $1 million. I'm going to give you 10% of ownership, and that 10% is going to net you X dollars at the end of the day. Therefore, that's the value of my charitable deduction. The IRS doesn't quite see it that way, as much as we would like to think it makes sense that they see it that way. Often what they're looking for is that the idea is that this is supposed to be a philanthropic gift, and therefore it's supposed to be given at a time where the value may not be 100% known. Therefore, that value needs to be, justified and created and established by an independent qualified appraisal. So that takes an added step in the process that most business owners may not think about when they're looking, and don't have to do, quite frankly, when it's Apple stock or when it's,
Sure.
cash on hand. So there's a lot of different steps through that process that make it complex, but they also offer the best rewards because it's a lot more than just the gift of the value of the asset. It's also that avoidance of capital gains tax.
Yeah. Hence the term complex assets, right?
Yeah.
I got ahead of myself. You're telling me so much fun stuff. I just start jumping ahead of the questions. Tell me, like your 20-year-old self, like when you were 20 years old and you're trying to figure out what you wanted to be when you grew up. Probably you didn't know that Charitable Solutions was in your future, right? So,
Correct.
what would you tell your 20-year-old self? What advice would you give your 20-year-old self if you could?
Oh, that's a great question. And it's funny because when I think back to my 20-year-old self, there was so much in flux with my life, and there was so much that was just all over the place for various reasons. And I think, one of the big things I would tell myself is, and there's a great phrase. I have a mom of young kids, so Bluey is a
gotta
integral
love
part
some
of
Bluey.
my
Yeah,
life.
yeah,
And
yeah.
there's an episode where the mom is talking about the kids having to run their own race, and I
Love
think
it.
that's very
Yeah,
important in the
love it.
sense of really maybe reminding myself at that point that I needed to run my own race and not be as concerned about what everybody else around me was doing. But I think too, looking back, I'm grateful for the fact that I was always open to opportunities as they were presented to me. So I think I just want to remind myself that's a good path to be on. That's a
Yeah.
good gut instinct to follow. As I talked about a little bit, it was kind of a non-linear path that brought me to Charitable
Right.
Solutions, and each of those things along the way just happened to be that somebody, I was in the right place, right time, where the right door or window came available, and I chose
Yeah.
to jump right through it. So I think, making sure that my 20-year-old self remember or, you know, still follows that instinct, I think would be very important as well.
It's not a sprint, it's a marathon.
Yeah, exactly.
Cool. Similar lines, what's the best compliment you've received sometime between age 20 and today? What's the best compliment you can remember receiving?
I think one of the biggest things that I can kind of tie back to, and I don't know if it's a particular compliment, but maybe a common theme of compliments that I get very often, is the idea of, I think back to years ago, there was a gentleman who's since passed. He was a professor, I believe, at Carnegie Mellon, and he wrote a book. His name was Randy Pausch, and he spent time as a
Another book, sure.
Disney Imagineer and talked about kind of his life path, and had used the phrase about how you could either be a Tigger or you could be an Eeyore. And I think more often than not, when I think about compliments, I think it is more along the lines of folks would probably equate me more as a Tigger, and I think that's always tried to be one of the things that I try to keep in my mindset. I think another part of that maybe ties into, my grandmother, who always just seemed to kind of live her life by the Serenity Prayer, and if and she accepted the things she couldn't change, and if she could change it, she would, and if and wouldn't sweat the small stuff, so to speak. So I
Yeah.
think those are probably a couple mantras that I kind of think back on, where I feel like get reverberated back to me the most
Okay.
when I'm around people and when they give me a compliment. So
That's awesome. That's excellent. I'm one of the reasons I'm laughing is I have two young golden retrievers. One's 3 and one's 2.
yeah,
About 6 months ago, we took them to the trainer,
yeah,
and when I went to pick them up, the trainer said, "Okay, you have an Eeyore and a Tigger. You have one of each." I said, "I know which one is which. That's right." The one is like I say he's the same. He's the Allstate insurance commercials with the character is called Mayhem.
mayhem, yeah.
The dog is about to be renamed as Mayhem. So. Okay, let me shift to some business questions for a minute.
Yeah.
Intersection of exit planning and philanthropy. I think I have a good understanding of it based on conversations that we've had before today. But you've been a SEPA pushing 11 years now, so you've seen a ton of change and a ton of growth. When you're having those conversations, when you're at the Exit Planning Summit, how are you advocating? How are you teaching all the rest of us about how we integrate charitable giving as part of the strategy of the exit planning process?
I'm happy to say that over the years, I think that conversation has been getting easier. If I were to think back in 2014 and, first getting engaged with my SEPA designation and first talking about this with other professionals, I think there was a lot of pushback that I would get in regards to concerns about whether or not this could even be done. Whether a business owner could integrate charitable strategy into their business exit. What would the buyer think? Would the business owner really do it? What would the tax professionals say? What would the attorneys say? And there's no way that any of this can really happen, that the stars can align for this to work out. And I'm pleased to say that over the last decade or so, that really has shifted. And I think I see that a lot doing this almost daily with charitable solutions, is the idea that, there's a lot more buyers that are receptive to the idea of the donors building this into their plan.
Yes.
There's a lot more SEPAs that when I talk to them about this being the work I do, they say, hey, yeah, that's a great idea. I know some business owners that I think would really want to get engaged with this and really learn more about this. So I think, rather than it being an afterthought, I think there are more people that, for various reasons, are just really beginning to lean into that idea of looking at how the business owner is maybe doing their giving currently, and then looking at, how they can implement that into a longer term strategy down the road. Whereas I think prior to that, there weren't a lot of advisors asking about the corporate philanthropy or asking about what was important to the business owner as part of those next phases after leaving the business.
Okay, and I know this answer because you and I have talked about it, but for the listener, how many of these transactions in 2025 will Charitable Solutions be a part of?
Hundreds. So, I mean, last year, as a combination of real estate and closely held business interests, we did close to 300. And we are, I believe, already past that already for 2025. And we haven't even really hit our busy season yet.
Sure.
Our busy season, as you can imagine, and as we were talking about earlier, tends to be driven by taxes, in some cases just as much as philanthropy. So there is a lot of push towards the end of the year and those end of the year deadlines. So this is getting into our very busy time of the year, and we are beginning to see that there is a lot of activity that'll probably increase as we go through these next 2 months.
Bet.
We are very busy, and like I said, it is pretty much almost daily to some degree in regards to either a business interest gift or a higher value real estate gift. And I'd say of those 300 last year, probably about 2/3 of those were probably business interest. And it's likely to track about the same for this year.
Great. So for those of us that are in the SEPA, we're at the table as a SEPA, and it's probably not relevant in terms of what role, but how soon in the process should we be calling you? How soon should we be putting you on a Zoom call with our client to understand the concept and how it works and why they should consider it?
Well, I definitely think the discovery phase is extremely important in regards to talking through where this sits in the values of the business owner. That may not necessarily, depending on where they are on the timing of their exit, that might not be where we come in necessarily, but I think that needs to at least be on the game plan in the discovery phase about how much this should be part of what's being built into the thought process. And, there's a lot of arguments that I would like to say, and that there's been proven out through some research with Harvard and with other entities that have talked about the idea of, from a softer perspective, the way that the corporate philanthropy can help increase that value acceleration.
Okay.
It's squishier, it's harder to prove than other cases that you might try to accelerate value, but it is there. So I think from that discovery phase, if the business owner is doing some level of corporate giving, how can they lean into that more while they're working on their value acceleration? And then how do you look at aligning that, in the exit strategy? And then, for something like a Charitable Solutions, once they start getting to that stage of getting ready to go to market on the sale, that's probably where we would play more of an active role of engagement in that part of the process. But definitely building that into the early stage plans is extremely important in regards to aligning
Okay.
the owner for what they're really trying to intend for their goals and aspirations.
Okay. So
Yeah.
if my client this week who told me I want to be out by the end of 2026. It's not too soon. It sounds like today is not too soon for you to introduce them to you.
Right. Yeah, because there's definitely some things to lay the groundwork that they'd want to double check on sooner rather
Okay.
than later. So yeah, doing something now if they're looking at for 26 is definitely a doable timeline so that
Okay.
they can make sure that they start getting the right things in order.
And you taught me that there is such a thing as too late.
Yeah.
What's too late and why is that even a thing?
Yeah, so as I mentioned before, from an IRS perspective, they like to know, and this is kind of the push and pull I think sometimes that exists in these strategies, is the IRS likes to know that this gift is truly charitable, that this gift is, the idea that it's not because the business owner knows that the sale is going to happen. So the IRS likes to see that this gift is being made when there's still a level of risk that the
Okay.
sale may not come to be. So once you start getting into documents that are legally binding, once you start getting into the idea that,
Okay.
this deal is 90, 95, 98% complete,
Yep.
then you start reaching a point where the IRS is like, yeah, no, you're too close. You're in that
Okay.
red zone. You're in that line where, you may still get a charitable deduction, but you're not going to get the capital gains avoidance. And oftentimes
Got it.
that
Okay,
capital
that makes
gains
sense.
avoidance is the icing on the cake.
So a signed letter of intent's too late.
A signed letter of intent, if it's not legally binding, can still be a good time. Where
Okay.
you want to watch is that gray area between the signed letter of intent and the purchase and sale agreement. You definitely
Okay.
want to try and be closer to that signed letter of intent than that purchase and sale agreement to be able to look more realistic in an audit as to where that aligns. If you start
Okay.
getting too close to that purchase and sale agreement, then that starts to be a little challenging.
But I've gotten hired this week as an investment banker, and I think we're 10 months from a transaction. That's not too late.
Oh no, that's not too
Okay.
late. No, that's a great time to begin laying the groundwork and to really look at, what you want to build into the strategy, what those from a loose basis, what those numbers may be when you're running those numbers on the deal terms and what the net's going to be, how much of that may want to be carved off for philanthropy. So, a great strategy that we see that doesn't always happen is the idea that this gift is already built into the letter of intent. The idea of the existence of this gift is already in the letter of intent. And we don't
Okay.
always see that, but that's really, if I were to call it a holy grail, that's probably the holy
That's
grail
best
of
practice.
yeah,
Okay.
is really being
Good.
able to have it where that's already present. 90% of the time that doesn't happen, but, ideally perfect world scenario, if we could strive for that being more often than not, that would be a fabulous outcome 5, 10 years into the
Okay.
future.
Very nice. Okay. So you shared with me a table. So I'm gonna have this go up on the screen now. Talk me through a real example where a non-cash donation was part of the exit plan. And so, what does that mean to the seller when that did happen versus what did it mean to a seller if it did not happen?
Yeah, so the biggest value in this a lot of times with business owners is not necessarily the dollars and cents of the gift itself. It's that's a great gift in and of itself, and that can be done, before the sale, after the sale, and still be $1 million gift, let's say. I think in this strategy we're talking about the idea of $1 million gift on the value of a business that's $10 million. Just a 10%. A fairly easy number that is achievable to a number of the business owners that may be out there and going through this strategy.
Okay.
When you look at that, either way you slice it, $1 million would be going to charity. Where the fringe benefit is on this is the idea of that capital gains avoidance. And the idea that, that business owner who probably created the business, who probably started it from zero, is really going to be working on the idea that that capital gains exposure is huge. It's huge.
If your basis is zero, you
If your
bet.
basis is zero, and so the idea that, if you look at that $10 million, if you look at the idea that that business owner, if they make the gift prior to the sale, and that gift is $1 million, they're not paying capital gains on $10 million. They're paying capital gains on $9 million because they didn't own $10 million at that point.
Yep.
They own
Okay.
$9 million. So it's the ripple effect of that. So their capital gains exposure is less because
Okay.
they have less ownership than if they were to make the gift after the sale. And the ripple effect of that means that there can be, more cash going to the donor because there's less taxes paid because of that capital gains tax avoidance. So that net benefit to the charity is still going to be that $1 million, whether it's before or
Okay.
after. But oftentimes we can see that that added savings on that $1 million gift to the donor can be anywhere around 220. In this example, we're talking about $225,000
Yes.
in additional tax savings that is going to the donor through that capital gains avoidance and that ripple effect of what that means through that process.
You mentioned you were in commercial real estate. Commercial real estate, not commercial insurance, correct?
Correct.
All right, but you earlier you used the word risk, right? And you talked to me about there's some element of risk management here, right? Nothing
There
is
is.
unless my client is donating NVIDIA stock, there's some level of risk that everything's not going up and to the right.
Right.
How do we blend these things? How do charitable planning and risk? How do you work through that with clients?
So a lot of that's where we kind of come into the idea of the long range intent of the donor to be philanthropic. I mean, this is not going to work if the donor isn't already charitably minded to some degree, because there is risk, and there is risk that, the current negotiations or the current buy that the donor's looking at doing may not happen for various reasons. Ultimately, the nonprofit, in this case, Decamai and Charitable Solutions, would still be a partner in that company. Now, going back to the analogy of the 10%, we're a minority. We're not going to be controlling anything. We're not going to be trying to run the widget factory because Lord knows we don't want to.
Right.
But ultimately, it is an irrevocable gift. So there is the risk that, you may make the gift and something may happen, and we're holding that for a certain length of time.
Okay.
Oftentimes, so the donor has to be comfortable with that. The charity, the reason why we step in to help the charities in this aspect is because they don't want to be holding it. They don't want to be part owner in a widget factory.
That makes sense.
So
Sure.
it's risk mitigation on both sides in the sense
Right. That
of,
makes a ton of sense. Sure.
that process. So the donor does need to be comfortable with their philanthropic intent behind this, front and center, and they need to be comfortable with the idea that, if for some reason something happens, yes, we're still going to be on the cap table. Yes, we're
Yeah.
still going to be present. If the company spins off dividends, we'll be getting some of those dividends for a period of time that'll add to their philanthropy. But, it's interesting because a couple times, we don't see it happen often, but I think just as many times as we've seen it happen in a way that the new buyer that comes in is coming in at a value that's even higher than what the previous buyer would have been. So there's even more going towards philanthropy than what would have been the case had something happened in that initial intent. So,
Sure.
There was a case I worked on a couple of years ago where I think, we held the stock for probably about 3 years. And it was actually that same buyer that walked away that came back 3 years later. And they paid, I think it was 50% more than what they were going to pay 3 years previous. So while, the tax benefit is still based off of that gift 3 years ago, the charitable benefit that ended up with that donor and what they were able to grant out at the end of the day had increased dramatically. So, I think, that's where you're kind of counting on that philanthropic heart or that philanthropic intent of of the business owner really being the thing that's helping to guide this, because there is going to be risk. But they're still going to get the charitable deduction. They're still going to be able to get the charitable benefit. Worst case scenario, it's not going to happen in that 10-month period of that first investment banker. It might be a 12-month period, a 24-month period, but it'll ultimately happen.
Yes.
And in the meantime, we're just kind of sitting there in the backdrop waiting for that, just like the business owner is. There's some rare circumstances, depending on ownership, where we do have a little bit of a ticking clock with
Yes.
what's called, with the idea of what's referred to as excess business holdings. So if, we have too much ownership alongside with the owner, then we may have a little bit of a ticking clock in that. But oftentimes that's very manageable. And I'd say it's even more rare that we see that we are holding on to those assets at that length of time, even if something does change the dynamic from that initial
Okay, all right. That's a follow on, because I was thinking about this parallel question.
Yeah.
In my world, what we have what we call red flag events. Do you have red flag scenarios? When is it? Do you ever have a conversation and you tell someone, you should either wait on this or you should simplify it? That kind of what they're initially proposing doesn't make sense.
Yeah, there's definitely been times with that. I think the biggest thing we find as red flag is going back to what we were saying about the timing.
Right.
And that really is driven less by us, more by the donor's attorney and CPA, because oftentimes when we're being introduced into the conversation, this may not have been something that had been truly vetted with the attorney and the CPA before we're introduced. So it's kind of like, hey, I get that you're at this phase of the transaction, but have you talked with your CPA about what you're trying to do and what they think? Because ultimately, it's the CPA that's going to have to defend them if the IRS, does an audit.
Sure.
This is too close. So, oftentimes we see the CPAs as the ones that'll kind of help make or break this, because if they feel like it's too close, then it's very seldom we see, the gift go forward in that sense. So the timing perspective of how you're timing the gift is probably the biggest red flag scenario we run into. Sometimes it is a matter of, whether there's other factors that might create a challenge. And some of that may be, we're looking at this just like an investor. I mean, we're taking the risk of being a 1%, 3%, 5%, 10% owner in XYZ widget factory.
Okay.
So if there's some things that we're seeing in the financials that might raise concerns, another big thing that we try to look out for is related to unrelated business income tax. If we have, if there's a lot of debt with the company, that might create a lot of unrelated business income tax for us and having that ownership. That might be something that we need to look at as, this might be something that may be evaluated. Hotels and apartment buildings don't usually make really good gifts because they're usually very heavy on the debt. And, someone trying to donate their limited partnership that is holding a hotel may not always be the right fit in that scenario. So those are some of the big red flags that we see, or sometimes the idea of they might be just too far ahead in the timing.
Okay. Is there a too late? Like I call up and I say, I just learned about Charitable Solutions, but my client sold 3 weeks ago.
That's too late.
Okay.
And now, mind you, there are still some strategies that could be implemented that wouldn't necessarily be, for Charitable Solutions. They could talk with their tax and legal professionals. A charitable lead trust is a great strategy for when it's, after the sale event, and being able to create charitable leverage still with the after-tax proceeds. But once you've got to the point of that purchase and sale agreement being signed, that is going to be too late for gifting the actual ownership.
Okay. Outside of your scope.
And avoiding that capital gains exposure, which tends to be the icing on the cake that most of them are trying to leverage the most.
Got it. All right, I'm going to shift gears on you a little bit and talk about a big theme of what we talked about in September at the meeting in Cleveland was collaboration across the SEPA ecosystem.
Mm-hmm.
You've been part of that ecosystem for just over a decade now. So you probably get to be a bridge between all the different faces and titles at the table. What's your take on an ideal collaboration and how you see that evolving in the SEPA community?
I think the ideal collaboration is really the idea of, it's not going to be a combination of the wealth advisors, the attorneys, and the CPAs, especially when you're getting in the near term of working through that transaction, and that actual liquidity event. Because they're going to be the ones that are front and center in a lot of that planning and that strategy and that process. So when you're looking at, going back to the analogy of 10 months ahead, ahead of the sale, or the idea of, meeting with the investment bankers, when you're in those early stage phases, those are all great people to have at the table to be able to understand what the donor's intention is and how to help get them across that finish line. There's a lot to be said in regards to, for those working in the value acceleration space, the idea of, looking at how that strategy, of what the business owner is currently doing, how they're using that from a social capital perspective, how they're using, integrating their corporate philanthropy into how they engage their employees and their staff. Okay. And their community and their brand and their awareness. There's a lot of very charitably minded business owners out there that are doing a lot of really great things, but they're not really leveraging it. They're not really showcasing it as a part of their company. They're kind of keeping it under the radar, and there's so much more that they could do with enhancing their value as a company and enhancing and leading their communities and encouraging other businesses to do similar things if they have more attention to talking about the work that they're doing and making it something that is just as appreciated in their community as what they do with their level of business.
Got it. From my experience, it's certainly true. It's a good description of my clientele and how they think about that. In your experience, what's made those SEPA partnerships most effective? Or conversely, what have you seen cause friction? What doesn't work in your experience?
I think the biggest friction sometimes is just that idea of it all happening too late. Okay. I think there's just, if there's not the pre-planning, then, it's harder to do this because not everybody has the right pieces in the right order. When you're getting too close to that finish line, when you're too late in the stage, one of the organization that I talked about previously that had the buyer come back 3 years later, that was actually the second business that we did with that donor.
Okay.
The first business never happened. And the first business never happened because the business owner and his team didn't fully understand what needed to happen, and they didn't have the right people at the table to be able to work through some of the nuance. His shareholder agreement early on did not allow for the gifting of the stock without approval of the board. The board didn't understand the strategy, and the attorney that was present didn't understand the strategy well enough to explain to the board in a way that the board would accept it and approve it. And therefore, since the board didn't approve the gift of the stock never happened before the liquidity event. So going into that second business, he definitely made sure all that stuff was in his operating agreement, but that was a lot of frustration for him, in that first company.
I bet.
To be able to really want to be able to do this, really want to be able to pull the trigger and have a lot of misinformation derail the process because everybody was not on the same page.
You alluded at the beginning of the call, you alluded to the fact that you are dealing with complex assets that oftentimes will need to be evaluated by an outside party. So in my mind, I'm envisioning like Antiques Roadshow, where someone rolls in with Aunt Verna's antique clock and it's worth $1.5 million. But I'm exaggerating. But give us some examples of unusual, complex assets that you've had to find somebody to give you a valuation on?
We just had a great one that we did recently, and it was a very, and I'm gonna not articulate this well because I was not the person front and center on this, but it was a very high-end car. It was about an $800,000 car that was used in a video game, and it was a very intricate model that was being used, crafted specifically for the purposes of this video game, and had a very unique market that we needed to sell to. Often
It was the original Chitty Chitty Bang Bang.
A little more high end than that, a little more souped up than that,
slightly more high end. Sure.
But it was definitely, and that's a unique thing in and of itself, because typically, as the joke we have internally is with tangible personal property, which the car fell into, is its own unique animal. The fine art, the jewelry, the watches, the baseball collections. The joke in our office is kind of, if you can pick it up and throw it, or you can pick it up and move it, that's its own unique bird
challenge.
In and of itself. With the business interest gifts, oftentimes we do see that, you're working with a lot of the same appraisers that you would work with, in the business valuations to begin with. But the charitable valuations take a little bit of an added nuance. You're not going to be able to just take the valuation that you got when you were working with the investment banker and slap it onto the back of your tax return and say, hey, I'm done. There's roughly about 10 to 12 different pieces related to the charitable gift in and of itself that the IRS expects to see in a qualified charitable appraisal. So that takes on its own nuance and its own niche. And it has to be tied in within a certain time frame of the gift. Okay. So it's important that gets set up in the proper process. More often we do see that appraisal done after the gift, so that they can look, the appraisers can kind of take into account some of the other dynamics that have come into play since the gift was made. But definitely it is its own unique separate document that's not typically going to be in your deck of what you're putting together with the business transaction.
The high end car, that's a great example, and I've had similar experiences. Some owners do have a very philanthropic slant on how they live their life, how they run their business, what that means to the business culture. You ever see anything that trickles down where it's more than just the owner? You ever work with an ESOP? Is that a thing?
Yeah, we've definitely seen not just ESOPs, and we've seen a couple different things. We've seen there's definitely, in my mind, and this is probably more anecdotal than I could say statistically a certain percentage, but there's definitely, I think, a strong correlation between those business owners that are looking at creating an ESOP as part of their exit strategy and building this into their exit strategy.
Oh, okay. Tell me more about that.
Well, if you think about the idea of, oftentimes business owners are looking at an ESOP because they want to be able to keep the business in the community. They want to be able to reward those employees that have been loyal to the business all that time. They're choosing the ESOP because they tend to be very community focused. Yes. So the idea of that philanthropy just begins to fit hand in glove with that, and building that into the strategy. On the flip side, as we've seen people exit, we have seen where there's been multiple shareholders, or there's been multiple people that are leaving that will do this strategy together. One of the most complex ones that I think I've done of my complex gifts was actually a group out of Utah where we had, I think, 12 different owners in the business, partners in the business, all doing this strategy at the same time.
Like on a prorated basis, everybody makes a...
Yeah, everybody had, picked whatever percentage made the most sense for them. I think overall with the 12 of them combined, it might have been about 10% of ownership in the company overall. But, because all of them were charitably inclined, all of them wanted to do something, it just made sense for all of them to do this strategy together. And it made sense for them to do it with us, with our organization, because then on the cap table, it was still just one partner.
Yes.
So,
yeah, that makes sense.
So, the buyer didn't care that it was all 12 of them. They were just dealing with one of us. That made a lot of sense for everybody involved in that scenario.
Fun. All right. The minimization of capital gains tax, everybody's going to be in on that. Okay, but the table we looked at a little bit earlier does show the reality that it is going to lower their net proceeds number. How do you all handle that? There's tension, or maybe you got multiple partners and some of them are all about that net proceeds number and they're maybe not aligned as partners. How do you handle that tension that it has to come up from time to time, doesn't it?
I think more often than not, I think there's a very close alignment in regards to, or net usually, it doesn't have as big of an impact on the net proceeds as you would think. So ultimately, the trade-off is very de minimis if it does. I think if I look back at the numbers, I think what we were looking at was actually, in this case, the net tax proceeds to the donor would actually remain higher by about that $200,000 or that $225,000. There may be a little bit of a difference depending on if there is a little bit of variance there if the company is an S Corp or an LLC. That may change some of that dynamic. But overall, usually this does end up being a net positive. Where we see the dynamic sometimes and where there is a little bit of that paradigm shift is really how much they want to put into philanthropy and how much they feel comfortable as it relates to that large number. And oftentimes there's multiple ways to build a mousetrap. So, it could be the idea of, maybe instead of it being a gift directly to a donor advised fund, maybe it's a gift to a charitable remainder trust so that they can still get some income. Maybe it's going to be a gift of, some of this going into the donor advised fund early, but then there's still going to be a gift of after-tax cash proceeds. So that they can check and see, okay, we've got this strategy that makes us happy with where we are with the pre-tax side of it. And then if we feel like we're super happy with the after-tax side of it, then there's a little bit more we may do. We referenced earlier the charitable lead trust. Maybe there's a little bit more charitable planning we'll do with the after-tax proceeds, that'll allow us to build a little more philanthropy if we feel more comfortable that at the end of the day we can do more. So there's always ways to maneuver with whatever the donor is trying to do in this. Ultimately, when they're making the gift from a pre-sale perspective, that is an irrevocable gift. So if it does make sense to scale that down a little bit so that they feel comfortable, and then look at on the flip side, what are some other strategies they can implement to add back into that bucket another way, then that's always an avenue that can be explored as well.
Okay. What an amazingly fun but complex job you have. Like, you're doing so much good and you get to help so many charities and you get to people who have that kind of heart for philanthropy but may not know how to do it themselves. So what's a bad day at the office for you? What has to happen for you to come home and bang your head against your desk and say, "Oh, my job"? It feels like it should be all unicorns and rainbows, isn't it?
I don't know if it's a bad day as much as the idea of there's still so much untapped opportunity out there.
Oh, okay.
If you think through what we see with the 300 transactions that I mentioned from 2025, that was maybe 30% of the calls we get every day. And, those were 30% that made it across the finish line. The other 70 that didn't make it across the finish line had a myriad of reasons why they may not have made it across the finish line. It might have been that they were too close to the deal. It might have been that, what they were willing to give wasn't enough of a gift to make it make sense from a tax perspective.
Okay.
It could have been that there were things in their operating agreements, or there were some other things that they realized down the line that made it so that the gift didn't make sense. But if we could figure out a way, as we talked about in regards to the earlier conversations and the earlier planning in this strategy, and not even just the idea of a win percentage for Decamai and Charitable Solutions about, upping that, but just generally, because I think what we see is no different than what some of our other collaborators that do this work see. If we could get everybody's batting average up,
Sure.
to,
The world's a better place, right?
3 out of 10, 4 out of 10, 5 out of
Yeah.
10, think of how much more could go into the communities that can fix the issues that we see going on in our day-to-day and with those around us that we want to be able to help. Think of so much more impact that could be done with that philanthropy if there was that much more capital that made it across the finish line.
Right. And I wonder, so you said 300, but there was another 700 that didn't make the cut, right? But you and I could probably dig up data that would tell us, okay, so that's 1,000, and that year out of that was 1,000 of how many privately held business transactions, right? In terms of broader market awareness to the investment banking community, to the CPA community, to the financial advisor. And I certainly understand that's part of the reason you're a SEPA and part of the reason you do what you do. But to your point, wow, the amount of additional good that could be done in the world is off the charts.
Yeah, and if you think about it, how much of that failure rate aligns with the original failure rate of business owners not selling to begin with? A lot of those may not have happened because the business owner didn't sell.
They didn't know.
So
they didn't sell, yeah.
If you think about the idea of in general within these transactions, there's already a high failure rate of the business owners that never make it across the finish line. By fixing the idea of why we're SEPAs to begin with, to help improve that average, also helps improve the philanthropic average. All of these things are interconnected, and all of these can have a profound impact for, everyone around us in our society. Yes. And the things that we want to fix the most, the things that we're most passionate about, the things we want for our life after the exit.
Yes.
If everybody can improve their batting averages in each of these scenarios.
Okay, now you're speaking into what my passion is at SecondWave Advisors, which is I'm all about what is driving purpose and meaning post exit for the business owner and any other shareholders, right, who have just spent 25 years of their lives finding meaning and purpose in the CEO chair, and now they're not in that chair anymore. How do you see the exposure to philanthropy help your clients? Are they finding meaning and purpose there? They kind of get their eyes open to a whole new part of the world?
I think this is where it becomes a larger group effort. And I think this is where this is important, to not only engage, the practitioners that are doing this work, like a Charitable Solutions, like a Decamai Foundation, like some of the other folks in our space that do this work alongside us, but also engaging, the nonprofits that are the beneficiaries of these dollars, and how they can better engage the business owners as well in this process.
Yes.
We need them just as much as the financial advisors, just as much as the folks in your world, Andrew, to be able to help make those business owners feel welcome, that there is a place for them in that next act of their lives.
Yes.
Help them brainstorm the ideas. I mean, we're just a transaction. We're taking the gift, we're liquidating the gift, we're pushing the money off to wherever that donor's philanthropy is next. We need the help of those other people that are on the receiving end of those philanthropic dollars to really help that business owner craft what's going to make them feel like they're still champions in this new life that they're creating for themselves. And how do we all do that together to bridge that path? Because that's where they still need help in feeling wanted and needed. And that, I think, also plays into whether or not they pull the trigger on doing this to begin with the philanthropy, is if they don't see a role that they may have early on in their communities about other ways they can engage. And that's where that corporate philanthropy comes back in the sense of, for the business owners that any general local nonprofit is working with now.
Yes.
If you're not helping them see a vision for how they can engage after they leave their business, then you're not going to benefit from these dollars when it gets to that point.
Yeah.
Because they want to be able to know that they're still going to be welcome, that they're still going to be needed, that they're still going to have something to keep them energized and charged. And if all you're doing as a local nonprofit is hitting them up for corporate sponsorships, then
Sure.
you're drastically missing the boat on the potential that you can have with these people, with all this knowledge, with all this capacity, with all this experience that they can offer. One of the best experiences that I had as a donor and as a volunteer myself was with a group called Social Venture Partners. And there's a number of SVPs all over the country.
Okay.
And a lot of what they do is they engage donors, not just in their treasure, but in their time and their talent and their testimony and their network of people that they can expose to. And
Yes.
a lot of their members in their footprints were business owners or newly retired business owners, because they had so much to give to some of these partners that they were working with through SVP. And that's where they really had a lot of passion and value, was being able to be these advisors to these nonprofits and share what they knew about the business world and help these nonprofits really kind of supercharge themselves, through their guidance and expertise and being that valued partner. And it wasn't a board position. It was more of, there's a great book I read at one point that referred to it as kind of scaffolding. It was kind of that external support to these nonprofits.
Yeah,
and they could come in and help reinforce and then move on to the next thing.
Yeah, cool. All right, two more questions for you. One, what's coming? What's emerging? You and I heard from the leadership team at EPI and what their vision is for where the whole SEPA community is going. What's emerging tools and trends in the philanthropy world?
I think there's just a lot of room for growth in this space. I think we're definitely seeing the role of, more of this happening in regards to these types of gifts. And the idea of, I think I talked before, and it's not really business owner driven, but the idea of, we're seeing a lot within the precious metals space. I've had, I just had a armored car go to a little old lady's house to pick up $2.5 million of gold that her husband
crypto.
No, it was gold.
I know, I'm teasing. Yeah.
It was gold.
How little I understand about crypto.
But
$2.5 million of gold from her house,
gold
from her basement.
That her husband had been collecting, and he passed away. And she's like, I don't know what to do with this. And so we just, but with the prices of precious metals right now, we're definitely seeing that. Crypto is ever evolving, and there's definitely a lot of that we're seeing. So I think, and I don't know how much of that we would see related to the business owners right now. I think more of that is stuff that they would maybe engage in after they leave the business. But I think the idea of really looking at those tools beyond just the idea of gifting to a donor advised fund. Looking at the strategies of implementing, a charitable remainder trust, a charitable lead trust, a charitable gift annuity. Charitable gift annuities were always thought to be something for $50,000. And we see a lot of, high-end real estate, or, we're seeing a lot of business owners that may look at the charitable gift annuities instead of a charitable remainder trust. So looking at those blended gifts, I think, is probably the big wave that we may see more of, is how to blend so that the business owners are getting that philanthropy, but still getting, some personal benefit for themselves or their next generation, and setting up their kids or their grandkids to be the beneficiaries of the income that may come from the charitable trust or the charitable gift annuities. You know, a
Excellent.
lot of it is all cyclical, but I think we're kind of, going into that everything old is new again with some of these blended gifts and these charitable trust strategies and CGA strategies.
Okay, hey, all right. As we wrap up here, my job is to get this conversation in front of all of our SEPA sisters and brothers as we conclude here. What's your advice for SEPAs that the light bulb has gone on? They want to integrate this. What's your advice? How do we do it? How do we get better at it?
I think the biggest thing is, I think the biggest roadblock that I feel is there with a lot of folks is just the idea of feeling like they need to know everything before they talk to their clients. And I think the one big thing that I think SEPAs are probably better at than most is the idea that they know that they've got arrows in the quiver. They don't have to know everything before they start bringing it up to their client. They know that there's other people that they can reach out to, and in this wonderful multidisciplined community that we have, to be able to say, here's someone you can talk to. It's great to get a good baseline knowledge just to be able to open that door and really talk to the donors about what's important to them, what they're doing with their giving, how they feel about trying to have those conversations. And even if you haven't done it historically, I think a lot of times, especially with financial advisors, the stumbling block I would always hear is the idea of, we've never talked about this. Why, how do I bring this up now? There's always a great time to bring it up. And there's always a great time to be able to say, hey, I just stumbled upon this conversation and it got me thinking about the fact that you and I have never talked about this before. And I'm just curious as to what your thoughts are about something like this. Being willing to open that door and being able to enter into those conversations, even if you're not the expert, but knowing that there's experts that you can reach out to. I love having these conversations. I can have these conversations all day long. This could easily be a 3-hour podcast if you let me do it.
Maybe we'll consider this the first episode then, and we'll restart in a couple weeks
to help give you a baseline education, to help walk you through things to build into those initial conversations, things to be able to test those waters, and then just know that you have resources you can call on to help get you the rest of the way there.
I love it. Laura Malone, thank you so much for what is apparently chapter 1 of the conversation. It's great to talk to you and love the conversation. If you're interested in learning more about what you heard, including learning more about becoming a SecondWave advisor, please use the link in the description to visit the website, and you can receive the first few chapters of the book for free.